From the morning reading, the SPY/SPX hangs on to a higher close after a strong opening gap up. Netflix up and after hours on strong earnings per share. 4 of 9 sectors moved higher on Tuesday. XLU, XLP, and XLY were the strongest sectors, while XLE was again the weakest sector. Oil fell 55 cents from Monday's close to $29.98 to close at $29.43. Breadth strengthened as decliners led advancers 2.06 to 1 on the New York Stock Exchange and 1.94 to 1 on the NASDAQ. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:40 a.m. Central Time, and I'm recording this in preparation for the market day of January the 20th, 2016. Remember that on YouTube, you can have a free subscription to the channel and be alerted to the new content as it's being published. Do give the video a few minutes after being published for the video to be available in high definition, which can be important on some of these charts and other graphics. Click on the setting button to choose a high definition playback level. Also in the same area, you can control the speed of the playback. I routinely find that I can fully understand videos that I listen to at about 1.5 times the recorded speed. So that could take about a 20-minute video and cut it down to about 13. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into our morning report, and indeed we have had fireworks once again in the overnight. At the time of this cut, we were down about 35 points, and it's actually down 36 right now, almost 2%. Russell's down also about 1.75%. Nasdaq's down over 2%. Dow is down right at 2%. Crude oil is probably the instigator for much of this. It's down about $1 or some 3.33%. So crude oil absolutely getting crushed. The euro is down about a quarter. Bonds are up about 3/4, and gold is up about 3/4. In terms of overseas action, it is quite ugly there as well. So no support coming from our key overseas markets. China down over 1%. Hong Kong down nearly 4%. And you have to start thinking about where our kind of triggers are when you start having opens like this. Japan down 3.7%, Germany down over 3%, as is the United Kingdom. In terms of macroeconomic reports for today, there are some mostly associated with building and housing. Building permits and also CPI and housing starts are all on the slate for the United States. In terms of tomorrow and looking forward, you have the weekly variety of the unemployment claims. You also have Philly Fed manufacturing. This one has not been a very pretty one in recent reports. If you're a nat gas trader, you also have your inventory report tomorrow. So keep that in mind. In terms of volatility, we have had volatility for sure. We did not actually put in technically a standard deviation move yesterday, but frankly, that's something of a ghost. On the S&P futures, if you look at the overnight, there was a range of some 50 points between the overnight high and the intraday low. Huge rejection. We'll take a look at the charts in just a second. But technically, there was no standard deviation move put in yesterday on any of the 4 broad market indices, and that close to close, it was largely the same. In terms of IV percentiles, these are very middle of the road, but of course they've been climbing of recent. You have 50 on the S&P, 59 on the Russell, 54 on the NASDAQ, and 57 on the Dow. Skew remains quite elevated at 137, running about 6 times normal and about a 12% probability of having a 2 standard deviation move in the next 12, or I should say 30 days. Short-term VIX now up over 30. So we're starting to get some real fear premium being priced into this market. It seemed like for a while there we were dropping, price action was weak, and yet there wasn't an awful lot of relative fear for just how much drop we were having. Well, that seems to be starting to come in line now. And indeed, let's go ahead and bounce over to our chart. And I've gone to the futures again because we've had such an overnight action. And you notice here I had this support line drawn across here. And this was a very important area in that we had these kind of intraday or overnight lows in relatively close proximity that were seemingly holding up as support. You had a touch here, couple, 3 touches in this general area, little whiplash poke through there that was then rejected. But, you know, there seemed to be some support being recognized in this area. Well, all that fell rather quickly in last night's overnight. And then also this one right here, that also you had a couple touches in this area. It went right through that as well. And where are we now? We're right on the August low for the S&P futures. So this is kind of, as it were, the last line in the sand in the near area. You do have the prior year, and this is going back to October of 13. So we've taken out all this near-term kind of stuff. Well, I should say all but this last line in the sand, and we're sitting right there right now. And then behind that, to backstop that, is this one here at about 1812, we'll call it, on the current contract. Remember, this is a continuous contract, so they re-level things as they flow from one futures contract to another. But on the chart, we'll call it 1812. We're currently trading about 28, so about 16 points away is this backstop. If during our, and we've got some time yet to go before the cash opens, but once the cash open and all the market participants come in, what happens at that point? Do the institutions and other traders, you know, support this area, or does this give way? We have to start at this point talking about where might we go should these areas fall. We've had all these support areas fall so far. Will this one hold with this small backstop here? If that doesn't hold, the next logical place is down here at this level. And if you draw some fib extensions, you also see some interesting things coming in at around 1800, 1750, 1700, depending on where you draw levels and extensions and so forth. But most of the chatter I'm reading would seem to point to this this low right here, which is about 1730. There's also a fib extension around the 1750 area. You, of course, could get some exhaustion. You could get a rally, but where does it actually find support? If it gets through this area here, we probably will go down to the 1750 area. At least you have to think of that as a potential target. You know, this has been a big move down, relatively quick. We've got to be coming into some exhaustion patterns, and these are weekly bars now. I changed this over to weekly. This has been quite a fall, and we're right now representing about 15% off of this high to this low, and we'll be coming into bear market territory if we get down here around this 1750 area. So this is getting very, very interesting. In terms of the other markets, here's the Dow, very much the same. Basically, you've got the very last lines in the sand, as it were, before you kind of get into some real open space. NASDAQ also coming into areas where the support has got to hold, or you really get into some open space. And then the Russell, which has been the weakest, it's basically already gone past all that stuff, and it's already in bear market territory. So at this point, you're really just trying to figure out where it might exhaust, where might it just run out of sellers. and the buyers start to get interested. Let's take a look at volatility and go back to the daily. So as we would expect, volatility well up, not quite as high as it was last Friday yet, but certainly could get there today if we continue to break down. We have the August spike at this 30.83. So that should tell you in relative terms, where are we? Now, it's interesting that we're at, from a price standpoint, we're at the August lows. There was a lot more fear, and this thing all developed much quicker in August than it has this time. This has been kind of a slow motion rise of fear, and we haven't become as extreme as last time. But if these levels start to break and that open space opens up below, we may see that catch up, and you might see this volatility spike up over 30 in relatively short order. Now, of course, just when you get to these kinds of levels and this kind of fear is often where the bulls do come in, and especially if you're in a bull market. We're not in a bull market anymore. We are in a bear market. In terms of the intermediate trend is clearly bearish, but still we could expect that the bulls would at least attempt a rally or a bounce or relief bounce off of these levels, and that would take the volatility down. Bonds, as you would expect, are coming up here near these resistance areas, and I would expect that that would also be a cause for some people to potentially start taking some profits, taking and cashing in some stuff. So some of this money that's rotated to bonds, as it comes into this kind of key areas of resistance, could see some money coming off the table, and that money might be flowing back into equity. So we'll have to see if that actually happens, or if we have the failure to have capitulation and flushing patterns and bottoming patterns, and we continue to break, and we could go easily easily up into this 166 handle on the long bond. Let's get back to our daily report, and again, it's about as ugly as it gets here. Phase 5, the break of horizontal diagonal support. IBD status remains the same. Market and correction, accumulation distribution score for the S&P and the NASDAQ, an awful E. The GMI index remains a 0 out of 6, sell signal since 1210. That author very happily in cash. Stock charts decision points, you can see is basically a sea of red with some neutral, only one lone signal left that is bullish. In terms of the intermediate term market posture, we are severely bearish, and we also have a bearish sentiment line. So we expect that these bearish moves will be longer and more pronounced, and that the bullish moves will be stunted in relative terms. Position sizing opinion is at 0 for portfolio investor, and at 50% or less than 50% on the volatility metric. If we get up over 30, that will also go to 0. And that intermediate term market posture is about as ugly as it gets. Everything's below 20. Everything is severely bearish. Hedge warning status remains level 3, which is crash warning. And indeed, let me just mention real quickly here, I sent out an email to my subscribers yesterday and basically asked the question, how has your portfolio held up during the recent corrections? Well, I took a look at this hedge risk level and how it had performed during the 2 most recent corrections, which have been our first and second significant test of the risk management system, which was rolled out in late 2014. Well, we've really come through in really good shape, and I can certainly take some losses, but in relative terms, and I have taken some losses, but in relative terms, they have been very small percent of my portfolio, and certainly small relative to the percent declines of the respective corrections. Also, as expected, I've had to certainly adjust some positions, but this is part of the plan. Further, if the current correction becomes much larger, we're absolutely in great shape and will not incur any significant damage to our core portfolio. So a very unusual place to be compared to many other traders and investors that I've heard talking of late. These recent actions have really reinforced my thinking that it's really all about risk management to create a consistent core portfolio performance. And the profits that come during the 85% of the time the market is bullish, and they'll be there. But it's when the risk level goes up that it's time to take action. And my risk level system hit level 1 on July 27th. There was plenty of warning time that the market risk level had increased to start taking appropriate actions. With the break of the horizontal support during the session of 821, it went to level 2. And so even at that point, while we were in deepening weakness and it was coming on hard and fast, you still had time to take actions before it got really ugly. It went to level 3 during the session on 824, which of course was headed into what would become the bottom. In the most recent connection, we went to level 1 on December the 4th. Again, plenty of warning before things got ugly. Level 2 was first triggered during the session on December the 11th, again on December the 21st, and then finally on January the 5th. Risk level 2 plus on January the 6th, and finally went to level 3 on January the 7th. While level 2 and certainly level 3 don't happen before increasing levels of weakness are already present, the system appears at this point to be sensitive enough to recognize increasing risk level, giving plenty of time to take actions to blunt and reduce damage to the portfolio. It really will be only over greater time and experience that we'll get a real understanding of just how sensitive the risk management system is. But so far, I'm really pleased as it has kept me out of initiating a ton of positions at poor times. It has also allowed me to actively manage existing positions to reduce exposure and limit risk. And one thing to always keep in mind is that by design, I'm willing to miss some of the bottom price action and will often not catch the perfect entries off the bottoms as I want to wait for confirmed bottom formations prior to putting on a significant number of positions. On the flip side, I often start reducing positions relatively quickly as risk increases. My investing and trading style is to maximize returns during healthy markets and to reduce my exposure and risk during less healthy markets. There's a give and take here, but I'm willing to absolutely accept the outcomes of that give and take. That might not be for everybody, but it's probably instructive as we're dealing with this second correction and we're starting to, look at a bear market into the teeth that you kind of get an understanding of just what this hedge warning status has meant to the core portfolio and to our swing trades and other strategies, and also what it has meant in terms of performance. In terms of the specific metrics today, you can see a sea of red here, volatility-based, market decline, sharp increase warning. The VIX futures well up over 18. We'll continue with this distribution day count in market and correction status. Volatility ratio warning has flagged, so this was, can be a sign of kind of oversold and starting to look for reversal patterns. VIX phase, of course, is increasing, skew quite elevated. The week out expected move, some 75 points, and that was before last night's action. So you can see that's another warning as well. New highs, new lows yesterday, not as extreme as we've seen in some recent trading sessions, but still way high at 801. All 5 key intermarket risk aversion indicators are flagging as risk off. The fear and greed index, not quite as extreme as it was a day before, but is still in the extreme fear category at a 12, and I would expect that that will become even more pronounced with the trading today. In terms of special opinions, all 3 systems, option income strategies, covered calls, put selling opinions, all outside the acceptable window to initiate new positions for novice traders. And given the current breakdowns, I would suggest that aggressive traders should also be standing aside, sitting in cash, watching your watch list and seeing how those are developing so that when you start to see those bottoming patterns come in, that's when you act But this is not the time to be getting too aggressive by any means, even if you are a very aggressive and experienced trader. In terms of market posture, it's a sea of red here with only utilities and a little bit of neutral on the long term on consumer staples. These are the most defensive sectors, and guess what? They're the ones that are holding up. That is not the sign of bull markets. In terms of yesterday, we did have kind of a mixed day with energy ending up about down 2% and utilities up about 1.5%. So very skewed kind of performance. And you see the 1 day, 5 day, 1 month here, even 3 month utilities has been holding up in relative terms far, far better than many of the others. So that's enough for today. We have had a boatload of stuff to go through, and I'm just going to go ahead and go to the disclaimers. You see the disclaimers here and also the hyperlink here if you need to find the entire disclosures. Obviously, this is opinion and you are responsible for your own trading. We'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading. Protect that capital. If you take new positions, it probably is bearish positions with very nimble exits as the market can reverse in bear markets very, very quickly.